Welcome everybody to today's webinar about the challenges of scaling the financial processes in startups. In our interview today, we have on board the expert and CFO of IDnow, Joe Lichtenberger. Joe helped scaling IDnow from 60 employees to short of 400 at the moment. And for the ones who don't know you yet, Joe, maybe you can tell a little bit about yourself.
Yeah, thanks, Evgeny. As you mentioned, I'm currently the CFO of IDnow. I span a career going back 20 plus years here in Germany. I come from the States originally, where I grew up and went to school, but have called Munich my home the last 23 years. In terms of working with companies in the finance position, or either a CFO or as financial director, I've seen, let's say, a good broad scale of companies and very large companies with over several thousand employees, and been part of startups where your employee number is single digit, so to say. So it's a pretty broad spectrum, and really enjoy, let's say, the smaller scaling up part of the spectrum. It's really an opportunity to help grow things, scale things up, devise the processes, work together with people, and build something with your hands from the bottom up.
Great. Okay, that's interesting. So since you have seen this whole scale from starting with big and then also small, what actually brought you to the startup world?
I think it's exactly what I just mentioned. It's the opportunity to build something from scratch. I think that really, you put your own signature on. Sometimes when you come to a larger corporation, things are more settled and it's more difficult to change pieces out and in. But with a startup, you start with a blank piece of paper and you figure out, okay, what do we need now? You try to have some type of foresight. What do you need in the future down the road to make sure that it's able to grow with you as your business grows? And it's just the joy of putting all that together yourself and seeing it run.
That's very interesting. This is actually also one of my first questions. When scaling a company from 60 employees to 400, what kind of foresight do you need to have, and what kind of logic do you employ in order to structure your controlling, your financial tools, and your processes?
Sure. So I think the logic is, in the best advice is, you need to be thinking at least 1 to 2 steps ahead. If you pick a solution or you design a process for what you are today, but you know that you're on a pretty strong growth trajectory, you could very quickly outgrow that, and then you're starting from scratch. And anybody who's worked in the startup world knows that there's always a lot of change. I think that's kind of the de facto norm. But there's certain things it's good to have also stability where you can. So like if you're going to implement a expense tool or an invoice processing tool, it's good to choose one that you can stick with, and that stays in place until you have to step up to the next phase or so inside of the business, and try to keep try to minimize the amount of change possible to the organization.
This is very important because a lot of startups out there, they're actually thinking about, should they employ a big solution right at the beginning, or should they do it incremental? Do you have a suggestion of in terms of time, how long should a process or a tool be working until you think about the next step?
Sure. I mean, it changes, of course, with the growth of the company and the market. So I think looking back at what happened in 2022, with the growth of a lot of startups companies, that the brakes were put on. So it's always difficult to say what's a magical number. But my feeling is somewhere in the range of 2 to 3 years is a good life cycle of what you should be planning for your technology stack in the finance area. And then the next big question you ask is when's the right time to move away from the piecemeal solution and jump to a big ERP. And that's that's really driven by a multitude of factors. You have to figure when you're going to implement a large ERP system, starting from the whole selection process to the implementation to your live can be anywhere from 12 to 18 months. It's going to be very expensive. So you have to see that the budget is there. And as most startups, you're interested in growth on the market. So, investing €1 into a finance system versus €1 spent into growing the company with sales and marketing is it's a hard trade-off to make. But at some point in time, you do reach that maturity where it's necessary to make the step.
Right. Okay. That's very insightful. When you guys when you started at IDnow, I suppose the majority of the financial oversight was built on Excel, and with time you transitioned, I suppose, to some kind of different tools. What tools, what kind of tools do you think are interesting for startups to implement at what kind of stage? I suppose there is, liquidity tools, spend management tools, budgeting tools. At what times does it make sense to implement what?
Sure. At the beginning, I would really focus on what are your core processes that you need to really handle. So when I first started, the topic of incoming invoices, so some type of invoice and accounts payable solution was a big topic. And the other one was our billing system and how we were processing that. And both were very, very paper-based manual processes using very Excel heavy in terms of imagining what's going on. And that was actually, I wouldn't call it a quick win, but in terms of a jump in improvement in terms of what you see as an efficiency in the process, transparency, and just overall being able to manage those are very quick gains. Moving further down the road, you talk about budgeting tools and other cash management tools. Those I think are driven by, let's say, the complexity of the business. If you're a single entity startup, you probably just have 1 or 2 bank accounts. The treasury is pretty easy. But if you get to the point, for example, where we are right now, where we have now multiple subsidiaries, multiple countries, it starts to become a topic. And then you would start to think about that type of solution. So I would focus initially on core processes, make sure that those are up and running. And then it's really dependent on the situation. Look to see, okay, is budgeting a big pain point for your organization? Then think about the budgeting tool. If treasury cash management is important because you have cash sitting all over and maybe you have some debt on the balance sheet as well that you need to manage your cash flow very closely, you might want to think about a cash tool.
Right. Yeah, that's insightful. Absolutely. So back then, when we started working together, IDnow was just one single company, and then now over time you grew and you bought a lot, and now you have multiple subsidiaries. What is your consolidation process for managing all the different companies?
I think the pragmatic solution at the very beginning, of course, was just using Excel to do the consolidation. When we were setting things up, initially there was not too many intercompany topics that we had to address, and make sure that everything was clean. So it was somewhat manageable. But over time, of course, that complexity starts to creep in, and then as soon as your accounting team comes to you, nearly in tears because of the painful processes, when we sort of knew it was time to move to a more professional tool to manage the consolidation process. So we've implemented a tool, and that now manages the intercompanies transactions, does the eliminations, and produces a nice consolidated report. We've even last year now have, in terms of the audit, we've moved to a consolidated audited financial statement. So that went nicely hand in hand together with the tool.
And does your monthly accounts still close to the 10th, or does it take much longer to consolidate it all so that you have the oversight of the numbers?
No, we were able to keep the timeline in terms of closing the month and having everything done. The first couple of months, of course, there was a few hiccups, but over, after you do it a couple of cycles, then that evens itself out, and now it's a good running process.
Right. Often it happens that in different countries there's a different accounting tool used. So in Germany we have one, and in other countries there's a different. For you, did you guys transition every company on the same accounting tool, or do they still use their own and then consolidate in the consolidation system?
So we do have different tools in different countries. In Germany, it's pretty standard. There's a standard accounting tool that a lot of people have, and we have that as well. But there's kind of local champions in other countries. So in France, we use a different tool. In Romania, we use a different tool. But that is I think the nice benefit. One of the nice benefits, of course, with the consolidation tool is that it eliminates that complexity and just brings it in on your general, standard accounts. You have your nice consolidated reports.
Right. Okay, that was a very interesting about all the finance processes. And now we touched on the topic that you are not one single entity at the moment. You grew. So what does the M&A process look like for a startup when this is growing? What was your experience? How did you go about the M&A processes that you did?
So I think there's two potential scenarios or views, and we experienced both. So there was I would call the serendipitous route, which is one opportunity just presented itself. We weren't necessarily on the lookout per se, but we were always open to initial discussions and took the initial invitation. And one thing led to another. And at the end of the day, found that it was a good fit and made sense. So I think that's one route is just be open to those opportunities. They present themselves occasionally. The other route was we made a very concerted process together with our lead investor and said, okay, we're looking to expand this. We're looking for a company that fit a certain list of criteria: their geographic reach, their portfolio of products, their customer base. And then we started a very concerted search about that and run a very somewhat of a formal process in terms of, okay, we were looking very specifically for a certain size and certain character of a potential acquisition target. And once we started that, began initial discussions with a number of parties, and you whittled that down and eventually closed the deal with one. So some companies have a very explicit M&A strategy. It is part of the strategy is that they want to go out and acquire, either look for horizontal or vertical acquisitions to either scale or expand. And the other one is the more serendipitous route is, as a startup, sometimes these opportunities present themselves. So depending on what type of situation you are with your investors, can dictate that a lot of what's possible.
How many parties are usually involved in such an M&A process?
Well, it's one of those things. It's a little bit of an accordion. So, at the beginning, we tried to keep everything pretty close knit in terms of senior leaders and management, because it can create a lot of distraction for the internal organization, and that's what we wanted to avoid. Everybody's got their day job, and they should be working on that. And you running the process also have your day job as well, and this is something that comes on top. But as soon as you see that things are progressing, that's when you start to expand the circle. And then when we get to the end, ideally you're involving all areas of the company to make sure that they're then also starting to think about the integration, because that is the very much, that step is as much, if not more important than the acquisition itself, because if you don't integrate well, then the whole acquisition doesn't doesn't bring the added value that you had as a hypothesis when you started the process.
That's very interesting. So what does your post-merger integration process look like?
The ideal situation is that, by the time you're further down the process, you look that things are beginning to, or heading towards the finish line, so to say. That's the point where you definitely want to start wrapping up your PMI activities. We had let's say, it always depends on resources. You can throw a lot of resources at such an activity, bringing in consultants and freelancers and whatnot. But at the end of the day, it's really important that you identify a few key people who are really going to drive the process going forward. And these should be people within the company, or at least know the company very, very well in order to do it. Because at the end of the day, it's a lot about personal topics. So because you're going to be changing roles and responsibilities, and it's a very sensitive topic, and it's where you have the biggest fear or angst that comes into an acquisition process, is because people feel, oh, I'm going to become redundant, or my job is going to change, or I'm going to have to move locations, or I'm now reporting to somebody that I don't know, and so there's all these different personal topics that come up, and it's good to have somebody who can really manage let's say, the emotional side as well. It's as much as the competent side of the integration process. One other thing I would definitely recommend is you need to address some of the, let's say, the elephants in the room early. These are the roles that are available. This is the structure. Either you find something within that, or you need to separate at that point in time.
So oftentimes the CFO is also responsible for managing HR, and you are very active in this area, and you also play a very deep role in this area. So what do you see is actually the role of a CFO on the topic of HR?
Well, I think what I find really interesting about being responsible for the HR topics and recruiting is that sometimes they're very different challenges than when you have, as, let's say, it's a classical CFO. So sometimes it requires me to switch my hats a bit. Of course, on the HR side, there is several finance or administrative topics that are very comfortable for a CFO. So there's a lot of administration, there's a lot of contracts. As most software or tech-heavy companies, personnel costs are our biggest cost. So having a good grip on how that is developing, for budgeting and forecasting purpose, you really need to have a strong grip. But then there's the whole, let's say, cultural aspect of HR, and making sure that that's supporting the strategy, supporting the growth of the company. And I just have I have a very good, strong relationship with the CEO on this topic, and we manage that jointly together. And so that really helps me put on that different hat and think a little bit differently about the company. So at the end of the day, a lot of the HR topics are really not cut and dry, black and white. This is going to cost more. It's really, where do you want to invest in your people? Do you want to do more training? Do you want to relieve pressure where you might have too few resources? So really understanding those different dynamics and trying to get the most out of your most valuable asset, which are your people. It's good to have, let's say, both hats on when you're making those decisions. It's not a pure financial decision. It's not a pure, personality or cultural or soft topic decision. It's really a combination of both, and finding those right optimal decisions to continue to make sure you have a motivated, well-retained, and excited workforce to continue to help execute the plan of the business.
Cool. All right. Okay. So let's switch to the topic of finding investors. because I mean, you guys have been very, very active there. And so since you have had multiple funding rounds already, which grew over time a lot, what would be your tips for young companies and young founders and CFOs, how to manage investor relation so that you are close together, you pull basically into the same direction?
Yeah. So without the doubt, the number one rule is you have to start very early. You don't want to be in a position where you look at your cash flow and you say, okay, we've got a 6 or 12 month burn, and need to do something right away. You actually want to be starting as early as possible, because it's all about building a network of relationships with investors. The ideal situation is that you've built up a rapport with a group of investors, and then when you're ready to go to market, they've already met you several times. They know who you are. You've given them updates about the development of the company, and then you come to them and say, and now we're looking to take the company to the next level, and therefore we need X amount of investment, and this is how we plan to spend it. And so that's really the ideal situation you want to be in. So it's really about cultivating those relationships. And I've helped several startups now raise capital. I've done that both as a CFO or as an advisor to the company. And every time I've used this, basically a CRM system to manage the whole process. So I know who I've sent mails out to. I know I've had phone calls with, if I've exchanged documents. And what's interesting is that over time, that the value of that database that you've created in terms of your contacts becomes valuable, because I had a situation just last year where I was in very deep discussions with a potential investor, and this is something that I had developed the relationships 2 rounds previously. Back then, when we first had contact, it was too early for the investor, but by last year we had grown into the maturity where it became interesting for both of us to talk. And that wouldn't have happened, or I wouldn't have, let's say, had that exactly at my fingertips if I had been tracking it over time. So it's a good practice to get into, of just making sure that you're tracking all of these relationships. That's, like I said, the earlier the better, and make sure that you're building your network over time, because when the process starts off, you want to be ready to go out and contact that network and get in as many potential interested parties as possible, create that competitive environment where investors feel, okay, they need to go the extra stretch to attract you to invest in them.
This is a very good point that you just said. What are your tips for negotiating the actual deal, the actual investment deal in the end?
Well, there's, a term sheet or so has multiple different aspects to consider. It's not just valuation and the share price. It's really thinking about, you have to sit together with your current management team and the current shareholders. What are important issues? Whether it's a governance issue, whether it's you could have valuation, but you give different levels of liquidation preference. Those have huge impacts on the future outcomes of the business. So you want to have a good view on those topics ahead of time. My recommendation is always to keep things as simple as possible. I know that it's become fashionable in the investment world to add things like liquidation preferences and participating preferreds and whatnot. My experience is that always creates complexities and problems down the road. So try to keep it as simple as possible. Think about all the different elements: valuation, governance, structures, and making sure that you put forward what you think is best for the company, and you go from there and try to negotiate something with the new investor.
Very interesting, absolutely interesting. And when seeking for new investors, what kind of trends do you see coming up for the next year? And what might be the challenges that younger companies need to be aware of?
So I think the biggest change we've seen in the last 12 to 18 months is the focus on profitability versus growth. Back in 2020, 2021, even to at the beginning of 2022, there was still this very much focus of investors of growth at all costs. So that was a lot of money was thrown at companies that could show an impressive growth rate, but at the same time, we're still burning up quite a lot of money. That picture has completely changed and flipped around. So of course, growth is what's interesting to investors because that's shows the potential of the company, that you're in the right market and you've got the right product and you're going to market the right way. So growth is important, but if you're not a profitable company, it's going to be very difficult to start to attract later rounds of financing. So maybe you can get a seed, you can get your Series A perhaps, but later down the road, you're going to need to show that you're starting to turn profit, your cash flow is positive, and what you're looking to do is to bring in investment to help accelerate your business, what you've done before. So that's, I think, one of the most fundamental changes that has happened recently, and I would foresee that we continue to exist in this environment for the foreseeable future, which is definitely the next couple of years down the road. These things always go in cycles, so that could eventually at some point it will probably change, and we'll go back to a point where growth, multiples and whatnot go up, but there will always be some type of recovery. And it's over the last 20, 30 years, you've seen that cycle repeat a few times.
And now we are actually touching already on the next topic, and this is financial planning, because that's exactly what is important for the next funding round, basically. Let's dive into the actual hands-on financial planning. So how and we work together on the financial plans and everything. How do you prefer to structure your financial models?
You obviously experience it yourself. I like to do it myself. So that's how I really get to understand how a business works and ticks. So building the model yourself is one of the greatest exercises for a CFO to really understand, where are my levers? What's the impact of margins, prices, volumes, etc., that has on the overall impact on the business, and it really gives you a good feel, especially when you come into a company the first time. So when I first joined, that was one of the first exercises I undertook. How you build it up, you have to just think about, at one hand, you want to show the level of detail that investors will want to see. So they want to see cohorts, they want to see customers segmented by either geos or verticals. They want to see your different products. They want to see pricing evolutions, volumes evolutions, if that's appropriate. So you want that level of detail, but at the same time, you have to find at some point where you need to cut that off, because if you can go to a point where it's too far, and then the model no longer becomes manageable in terms of updating it, changing it, fine-tuning it. So it's really something you develop over time, that right level of detail, but not overly complicated, that you can't put that in the hands of a potential investor and they understand it very quickly. So that's kind of always been my approach, and I think the last round we did, we had 25 or 20 version 26. At some point in time, we said we froze it, and that was the final version. But it does take quite a lot of time to go through, and it's important also to use that as a tool to talk with the rest of your colleagues. You're talking to your colleague in sales and your product and your colleague in product and whatnot, and get them also involved and let them see how the model also works. That helps turn their thinking on what are the different levers, what's important, what is the pricing impact, what does that do to the business? Understanding, if I increase prices slightly, what happens to churn, what happens to your volumes, what happens to your overall profitability, so that they really understand that dynamics that works in the business case. It's a great tool, and it was one of the things that allowed me also to get to know, particularly at the beginning, when you come into a company at the beginning, to know the colleagues and work with them in a very detailed, but also somewhat strategic level, because you're talking about where you are today. You also want to have the conversation, where do you want to be in the next 12, 18 months down the road, and then, up to 5 years if the plan goes out that far. So it's a good exercise to go through to really bring everybody on the same page, where the company is heading and should be heading in the future.
Very, very hands-on, very interesting. For doing financial planning, there are multiple sides to it. One is the technical side, where you actually build this. And then obviously there is another side to it, which is more a human interaction, basically in the people business. So often when you present a financial budget or financial plan to investors, you face obstacles or objections. How do you overcome objections from investors when you show them a financial plan?
It's all about being prepared, right? So the questions will be, you'll get challenges on different assumptions, and what you want to make sure you've done, the exercise is a pretty rigorous review of historical data. So having historical data set up in a proper way. So we had the last financing round, we had a customer cube, we had a volume cube, and this allowed us to cut the data several different ways. Cohort views, vertical views, geo views. This allows us to come up with a lot of data analysis to show investors, okay, we are assuming in the future this trajectory because look, in the past we've done this, and then it becomes. Then it eliminates this. Let's say disagreement or discussion with the investors, because you've shown that everything has a reason why you've assumed certain growth rates or certain changes in the future, and it's based upon the data that you have. So doing that work is very, very, very tedious, and it can take quite a lot of time, especially if the data is not immediately available in the format you need. We actually, the last financing round we went through, as a result of that exercise, made several changes to our core systems to allow us to capture the data in a better format. So the next time around, we're able to automate that a lot faster and pull it out. So making sure that your data, and you've done your homework on those topics. And that's how you very quickly put those discussions aside with the investors, because then ultimately the discussions you want to be in is talking about the future potential with investors, saying, okay, there's new markets you can go to, there's new product expansion you can go to, and getting them excited about those different growth opportunities. That's a discussion you want to have, not taking challenges to your assumption in the business model.
Very insightful, and I think very, very important. And also, it is very often the case that a funding round forces you to improve your controlling processes, and then afterwards you have a better view actually on your own company than before. Yeah. Actually, one of the last questions I have is, what trends should CFOs be aware of when doing financial planning for the next year?
I think, as I mentioned before, the investors will be looking at the topic of profitability. So if you're not there yet, you want to be showing in your plan you're going to reach it by X number of months, and be able to convincingly present that. So I think that's one of the most important topics. But in terms of other topics, it's just to make sure that you've got a realistic plan. I think there is also been a pullback in terms of believability of growth and what's possible out there. Things have just slowed down a bit. And I think being more realistic in terms of what you can expect, and this will also help you with the cash management aspect, is you don't want to think that growth is just going to come and that'll solve all your problems. I think having a realistic, I wouldn't call it conservative, but a well fundamental plan that you feel comfortable that you can achieve that. There's always a bit of, how much fantasy and upside do you put into the model. I've always preferred to do that as a number of options to be explained. So you have your base case, and then that's as a plan that you feel very comfortable with achieving. But then you put something in front of their eyes and say, listen, if we can break into this market, with this product, this is a different growth trajectory that's very much possible and feasible what the company can do, assuming all goes well. And that's also the point where you want to get investors to start to thinking about these alternative scenarios, but at the same time having a base case plan that you can comfortably achieve that in terms of reaching profitability and positive cash flow.
Thank you very much, Joe. That's very, very insightful information. One last question. What would be your key advice or key takeaway for young CFOs?
Always be challenging. I think the biggest, let's say it's a weakness, or where young CFOs maybe don't establish themselves, is that they become too backwards looking in the business. They focus on producing the monthly report, and you get there and you've worked all night to finish it, and you put it on a table and say, this is what we did last month. But that was last month. Okay, it's important to understand where it is. But everybody at the table there is thinking about today and tomorrow's problem. So make sure that you're challenging and being active in those, and being an important business partner in helping make the right decisions for the future. So I think learning to manage, let's say, the accounting and historical and backward-looking aspect of the business, that's a must. And if you've gotten into the role, you've obviously done that, but you're expected then to help lead the company going forward. And so becoming a good business partner, asking the right questions, being a good sparring partner with your different colleagues, that's what's really going to put you on a good footing in the organization, and really show you that you're adding value as a CFO.
Perfect. Joe, thanks. That was really good.